I think the terms have actually been revised in the last quarter. Ever since we saw inflation come at where it is, and the Fed has been increasing rates. That's seen a little bit of cool off in the housing market. So we've selectively shaved off max leverage across certain products. So initially we were doing 90% purchase, 100% on fix and flips. Today, we'll very sparingly give that 90% at purchase. We'll typically like to stay at 85% purchase, just so that investors have more skin in the game as well. But outside of that, in terms of speed, in terms of execution, we've been faster and better than ever before.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Saurabh Shah is the co-founder of Instalend. He's a PropTech entrepreneur with extensive experience in real estate investments, asset management, and business development across the United States and South Asia. Saurabh, welcome to the show.
Hey, it's good to be here, Sam. Thank you for having me.
Hey, the pleasure's mine. There are 3 questions I ask every guest who comes on the show. In 90 seconds or less, can you tell me, where did you start, where are you now, and how did you get there?
Sure. We started flipping houses in Chicago as fixer-up properties. We today are lenders for fix and flip and 30-year rentals. And what was the last thing?
Where'd you start? Where are you now? How did you get there?
We got here by going through flips ourselves, knowing where there is a need for filling out the gaps, and eventually merging our backgrounds in investment banking, private equity, to real estate investments. So today we are a nationwide lender for real estate investments across fix and flips and long-term rentals.
Okay, fix and flips, long-term rentals. Is there any other part of your business that you guys are focusing on the lending side?
We also do finance for new construction, ground-up projects, and we're making this capital available across asset classes. So it's 1 to 4 unit single families, it's multifamilies, which is 5 units or more, as well as mixed-use commercial properties.
Wow. Okay, cool. And so this is a PropTech platform that you guys have built. It's called Instalend. And you guys are lending on all of these asset classes. Is that right?
Correct.
Okay, very, very cool. Well, tell me about this. I mean, that's a lot of moving parts. I guess from starting as a fix and flipper in Chicago to then saying, all right, we're not going to do the hands-on fix and flipping. You are now going to go out and do a PropTech platform and become the lender. How did you figure out the need? How did you find a creative, or what did you do to creatively solve and fix that need or fill that gap in the marketplace? Tell me a little bit about that.
Sure. So just to take a step back, I started my career working in investment banking on Wall Street. And as most individuals looking to tap into investment opportunities, real estate was one of my favorites. So having bought turnkey assets, what we really understood was that the underlying value in growth was with fixer-up properties. So we got down to the ground in Chicago, got our hands dirty, started fixing up properties. We did a few ourselves, and then we realized that there was a serious need of institutional capital in the space. So most lenders are commonly known as hard money, and then there's a separate segment of institution capital. We saw that the hard money lenders were charging exorbitant rates, institutional lenders were far out, and there was a big need for good yielding asset class products. So we decided to jump in as lenders, fill the void, bring down the cost of capital for most investors, but at the same time streamline the process, give it a digital first uplift in terms of loan intake, credit underwriting, time to close the loan. We brought it down to between 7 to 10 days, and just standardize the whole process. That's how we started, and at this point we've scaled the business, starting out from one single fix and flip loan to coming full circle to a long-term 30-year rental. And we also serve other requirements that our investors have in terms of type of financing, asset classes, and anything else that follows through.
Tell me on this is a question from the business development side of things. It's one thing to have an idea. It's another thing to go out and say, I mean, maybe you just have unlimited access or unlimited amounts of personal capital, but you need to have obviously a source of capital for you guys to do lending. How did you guys work that out?
So initially we started with our own book of equity, and we soon realized that it was not just 4 or 5 investors who we wanted to lend to, but there was like this whole group of investors that through referral came about and wanted us to fund them. And that's why we realized that if we had to operate at scale, we had to tap into a bigger balance sheet, and that's where the institutional capital got plugged in.
How did you even find the institutional capital partner that said, hey, you know what? I'm going to trust Saurabh and his team to go out there and lend our money. We're going to back them in what they're doing.
So two things. Number one, very important, is having a good track record. That worked out well for us because we fixed properties ourselves, we flipped them ourselves, and we were also lenders. And having seen the full life cycle of originating to having a loan paid back, we built a good track record in certain markets in the US. And then, like I said, there's always been a need for high yield collateralized secured products on Wall Street. So coming from Wall Street, I already had the touch points with capital partners who wanted to deploy capital, this color of capital with a certain type of asset class, which was outperforming yields.
Right. Yeah, absolutely. I mean, capital is certainly in seek of yield. And so if you're able to find the right projects and the right people to lend it to, that's a great match there. Tell me this, how did you guys, I mean, if you personally didn't have experience in multifamily or mixed use ground up development, how did you guys figure out a way to evaluate the the borrower and the project? What did you do to educate yourselves or your team members on what a good and or bad project is?
That's a good question. A lot of this growth for us was organic. So just as an example, I lent money to one borrower to go fix up one single family. He fixed it up and he decides to hold on to it as a rental. And instead of going to other lenders, he comes back to me and says, hey, Saurabh, why don't you guys roll out a product where, you can also give me a perm loan? I said, hey, why not? We already worked with you on the first loan, our first few loans. You've always performed. You always paid us back. Here, we'll go and create a new product. These borrowers, as they start scaling their portfolio and, then start looking at multifamily assets or mixed use properties, always came back to us saying that, we worked with other lenders, but it would be great to keep everything under one house. Since you have a full file on us, you don't need to run credit. Appraisals are already kind of worked out. If you can also roll out a product for mixed use and multifamily. So that's really how the inception kind of, for rolling out us came through. It was really organic, servicing the needs of our own clients and then rolling that out as a full service product through our platform.
That's awesome. I love that. How old is Instalend? How many years have you guys been in business?
We've been around close to 5 years.
Okay. That's a lot of movement in 5 years. There's a lot of probably growing pains, I would imagine, in a 5-year window. What have been some of the major challenges that you guys have faced and how did you overcome them?
One challenge certainly, that we faced both as, fixed flippers as well as investors was a lot of the times you can't gauge, the market in terms of where the underlying sale prices are or what your total capitalization cost is. So we've often encountered situations where, you budget a certain amount for the rehab to be done, but it could kind of spill over into a higher budget. So it's very important to build in a contingency. So you have that additional surplus capital to tap into. And, very, very commonly, and most recently, we've seen that coming through COVID, where we had supply constraint issues, prices kind of just skyrocketed. Inflation has been at its peak. So a box of screws, which used to cost about $100 back in the day, is today $250. So unless you have that contingency to tap into, you're going to put your project completion at risk. And if your project completion is at risk, then you're probably going to struggle to pay your lender back as well. So just, internal housekeeping, making sure you work with a GC, you build in a contingency, you're prepared for that rainy day is something that we've learned is important to build in.
Absolutely. What did you guys do when you ran into projects like that? Or you said, hey, you know what, we're out of capital, we're in the middle of our renovations. How did you guys as a company handle that?
I mean, it was really interesting because, the relationships we built are so organic. And, and we really have built it down to the homework on every dollar that has to go into the project. So a lot of the times it was just sitting down with our guys, sitting down with the borrowers, understanding what is the additional capital call that we have to provide to see the project through, and then building in those contingencies, whether it means refinancing your existing fix and flip loan into a new fix and flip loan, or just adding that additional leg of capital to finish the rehab, because there's already enough equity built in to give us some comfort that compensates any additional risk. So yeah, it's looking at the full perspective, the full picture, what the numbers tell you, what your exits are. And that's basically what helps us design a full package with a predetermined exit when we go into a loan.
Yeah, no, that makes a lot of sense. What are you guys doing differently now, maybe than what you weren't doing 5 years ago, just based upon where we are in the economic cycle?
We've recently rolled out two initiatives. One is we've started working with local appraisers directly, just so that rather than having nationwide appraisers reach out. Somebody who's not probably from the neighborhood, but still can go out and complete an assignment. As compared to that, somebody who's local from a particular zip code has a better pulse on the market historically as well as forward looking. So we've rolled out that initiative where we work directly with local appraisers. That helps us stay more consistent with values. Also cuts the turnaround time in terms of how long it takes to get an appraisal back. And the second initiative that I think somewhere sets us apart is we've also rolled out self-draw reports. So back in the day, we used to work with a third-party inspection company who would send out an inspector to verify the work is completed, and then we would reimburse the borrowers on their rehab draws. As compared to that, we've now launched a product where borrowers can take pictures themselves, geotag it, and then send it to us, which helps us verify the work is complete, and we can release funds to them. So this really cuts down any noise, any sort of distractions that come along, whether it means scheduling with your inspector, no shows or delays, or work not being captured correctly to its full merit. It's really just directly now between the investor, the borrower, and our draws team.
Yeah, and that has been a friction point, I think, for a lot of borrowers is that draw schedule. It's like, oh, okay, hey, cool, this work got finished Friday. Well, the person can't come out and inspect it for 10 days. They come out 10 days later and they look at it and it takes them another 10 days to get the report back. And now you're 3 weeks waiting on draws going, where's the money? So that's really cool that you found a unique way to solve that particular issue. Are you guys changing terminology in your loans any? And maybe the more specific question is, have the terms of the loans changed over the last few years in order to protect you guys in a different way, I should say, maybe than what you were doing a few years ago?
I think the terms have actually been revised in the last quarter, ever since we saw inflation come at where it is and the Fed has been increasing rates. That's seen a little bit of cool off in the housing market. So we've selectively shaved off max leverage across certain products. So initially we were doing 90% purchase, 100% on fix and flips. Today we'll very sparingly give that 90% at purchase. We'll typically like to stay at 85% purchase, just so that investors have more skin in the game as well. But outside of that, in terms of speed, in terms of execution, we've been faster and better than ever before.
I mean, and that's not a dramatic shift, 90% to 85%. I mean, I don't know, that to me isn't an egregious change, and obviously it's a change. You guys are making corrections inside of your company as you see fit. But I would think from a borrower's perspective, like, okay, 85 or 90, if you can't do 85, you probably shouldn't be in the deal anyway.
Exactly. I mean, serious operators don't really, not do a deal because there's a 5% additional equity down payment, because as long as the values hold up, there's profit in the deal at the back end. You're looking at more to continue a partnership with your existing partners. So yeah, we've not really seen any pushback or any slowdown in volume. In fact, most investors who've been around for a while have seen how the universal shift in terms happens through different life cycles. Just when we hit COVID, there was a credit freeze. Most lenders were not lending. Today, you've seen lenders go very aggressive coming out of COVID, and now there's again a little bit of hold back in being how aggressive one would be. So these are just basic cycles of real estate investments that kind of shift around as the market moves. but eventually, coming out of it, it's an equalizer, and the serious investors don't really seem to get bothered by a 5% additional pay down.
No, certainly not. What are some other things that you guys are looking at in your business, kind of on the horizon, things you say, man, this is the next iteration of your company?
We're certainly looking at short-term rentals very, very closely. We're about to launch a product. In fact, we've already run a beta test on it with certain investors. Where coming out of COVID, as travel has resumed, we see there is a good demand and yield in Airbnbs and other short-term rental products. So we have been financing 30-year loans for Airbnbs. I feel that would really help us uptick our volume as more people start resuming travel, start renting out Airbnbs again.
Yeah, I've certainly seen quite a bit of that, that change, and then seen some short-term rental programs and things like that come out. So that's next on the horizon for you guys. Are there, when it comes to the types of loans that you guys offer, what are the regulatory hurdles that you guys have to overcome as a lender?
Because the color of capital we have is private, we steer away from most regulatory requirements. We're asset based, so all we need is an appraisal report. We need a business entity which is in good standing. It could be an LLC or a corporation. And we are good with that. We do sell our positions. So, but from that perspective, the risk of regulation is on the counterparty and not us.
Man, that's great. That's great. Anytime you can be involved in a business where your regulatory risks are limited, that's certainly ideal. And it's kind of the answer I expected, but didn't know if maybe there were some things. Obviously, I'm not in your business, so I don't know. But maybe there were some things I hadn't considered that you guys have to consider from a lending perspective on what you guys do. That is very, very cool. I absolutely love it. Thank you for taking the time to come on today and tell us about Instalend. I mean, you guys are lending across all asset types, it sounds like, or at least the majority of them. So there's certainly opportunity for those who are listening to this show. If lending is something you are struggling with or trying to get a project financed, certainly you guys should reach out to Saurabh and talk to them and find out what it is that they may be offering. That is the last and final question for you here, Saurabh. But for listeners do want to get in touch with you and learn more about you, what is the best way to do that?
The best way is to just reach out through our website, instalend.com. It is a technology-first product. So if you need a proof of funds or a pre-approval, you can request one through the portal, and the system should send it to you within 24 hours. If you need to send us a scenario for any financing requirements you have, you can apply for a loan right through the website as well.
That is awesome. Saurabh, thank you again for taking the time to come on the show today. I certainly appreciate it.
Thank you so much, Sam. It's been a pleasure.